Hi, I'm Brett Mills. I've been in the mortgage banking industry for almost 25 years and been investing in real estate of all types for almost just as long. And you'll find that I love talking about this and teaching principles. Some of them I've learned by the School of Hard Knocks. Many of them are principles that I've just been a disciplined student of the industry. Got my MBA, I'm also a certified mortgage banker, one of the highest designations you can receive in the industry. Also a certified commercial advisor in the commercial real estate world on just helping to become a student of all things real estate. I want to be able to put that years of experience to work for you today. I have found that real estate and just having an intentional plan can help you create a framework for you to achieve really your life goals and visions. That's what we want to talk about, is we want to be able to help create that framework. As you think about to what your vision is, we'll try and help define that today. How do you quantify that? We'll be able to look at different diversification and different type of assets that you can put your money to work in and your ability to help achieve those opportunities. And we'll break down fundamentals of investment properties on every level, how to evaluate an investment property, how your different returns work on real estate, how you can leverage those and maximize those to help you achieve your goals a lot faster. You'll find as we go through this that you may ask, well, what about me? I see the framework, but how does that relate to me? I want you to be comfortable and hope that you'll feel comfortable reaching out at any time so that we can create your customized plan for you. There's no charge to do that, and I want to hear your visions. It inspires me, and I'd love to see people chasing their vision, and if we can help be a part of creating that framework and helping you achieve those goals, we want to do it. So excited to get started. Look forward to spending time together today. Let's head down to the conference room and we'll get started. All right, as we begin, I do have a handout. If you want to click on the information in the bio or send us an email, we can send that to you if you'd like to take notes, follow along, and be able to reference back. So you can always reference back to the video, but that's there as a help and a resource. So it'll help create a framework. So the first place I like to start when we're talking about really financial dreams is that just what is your vision? I find if we can start with the concept of where you're trying to go and what your vision is for trying to get there, it will help you be more successful. A simple story that I heard years ago that I think illustrates this. Let's say, for example, you're in a raft sitting in the middle of the ocean. You can paddle, but every direction you look, you can't see anything but water. Which direction do you paddle? Well, for most people, they don't paddle at all because what if they're going in the wrong direction? And so they sit. Well, there's always a current, and most people, that's how they go throughout their financial lives, is they just kind of go with the flow, or they go with the current. But if you see an island off in the distance, it changes your really direction and the intensity with which you would begin paddling, because if you saw where you were going, you could see it, you could define it. That does not mean that there wouldn't be resistance. That does not mean there wouldn't be waves crashing against you and the current would be going against you, but when you see where you're going, you can see that island off in the distance, you're more successful at achieving your goals. And so that's why when we talk about financial management and investing, we start with vision. Investing and trying to live into your future will always cost you something. And that's why vision is important. So many people, I think, inadvertently say, well, I'll invest if it costs me nothing. They don't really probably want to say it that way, but that's the way most people live, is if I have a few extra dollars left over, then I'll throw it at maybe my future. But if you can see where you're going, then you will make sacrifices that will balance both your current needs and your long-term needs in an appropriate way for you. So that's why vision is important. Your vision will be unique to you. For some, it's just I need the vision and I need to be able to retire someday. So what is that amount that you need to retire someday? Have you talked about that? Do you know how to quantify that? That's one that I hear a lot. Another may be, hey, I want to be able to help children pay for college. And that's something that's important to me. That's a different milestone. Or maybe you want to be able to provide a house for your child as housing's getting more and more expensive. That's the one that I hear quite often. Maybe you just want to have more life experiences and more flexibility and cash flow that you can travel or give to philanthropy or go and serve in different capacities. Or if I can understand what your vision is, then we can be a sounding board back and forth to one another and say, okay, how do we quantify that? So step number one is have a discussion. What is your vision? Now, if I talk about retirement and the amount that you need to retire, if I can share one principle there that I found helpful. Most of what we're going to talk about today is getting into a process of doing things. Creating wealth is really boring, and so that's why I want to talk about this boring process. It's more about principles and process. If you start putting 10% of everything you earn away into your long-term retirement plan, you're going to have options when you get there. 100% return on nothing that you've invested is still zero. You can't get to where you're going if you haven't invested anything, and so it requires our participation. Now, let's use an example. Let's say that someone making $60,000 a year invests 10% of their income into a wealth plan and retirement planning through their working career versus someone making $300,000 a year. Of course, the person with $300,000 a year is going to have more when they reach retirement than the person doing $60,000 a year. However, here's the thing that I found fascinating in studying wealth through the years. The person that's been living on a $60,000 a year income is going to be very happy in retirement. They're going to be accustomed to that lifestyle, and they will have what they need as they go into the retirement years. Someone making $300,000 a year is going to have a very different lifestyle. And so the important part is that you're putting that 10% minimum away to be able to create that wealth plan. So one of the examples I look at when often people, when I ask them, how much do you want in retirement? They don't really know. And so let's say, for example, you wanted $100,000 come in, or you have $100,000 a year coming in right now into income. Well, that would be a number I'd encourage you in retirement years to plan on at least that, because your lifestyle will change. I describe it as you go into those retirement years this way. The 60 to 70-year-old age group is typically the go-go years. You've got a lot of things you want to accomplish and experiences you want to have. The 70 to 80, I typically find, are the slow-go years. It starts to slow down a little bit on some of those experiences. And the 80 plus, life just changes. It gets harder and harder to go out and do as many things. You can still live in vision. You still have principle. You can serve in a lot of different capacities and have a very fulfilling life. But it's just a change in priorities as you begin to go through those phases of life. And I find that the expenses really don't change going through that period. It's just it shifts from maybe active life experiences to health care and comfort and quality of life type of expenses. And so it's important to define that. If you're living on 100 grand, have that discussion as a family. Can we meet our monthly obligations, and are we living the way we would like to? If that's $200,000 a year or $300,000 a year, it's important that we just define what that is, and it's your vision. It should be your number. I encourage people, don't create the plan under the assumption that if I have all my expenses cut, house paid off, everything done, by the time I'm ready to retire, that's the definition of financial freedom. Let's live a little bit bigger, and so we want to be able to help create that roadmap. So I have found in monitoring your financial plan, the number one thing to keep track of is not your income. I find most people look at it and say, if I could just make $20,000 more a year, then I would have what I want and life would look so different. But that's just simply not the case. The number one thing I encourage you to track is something called your net worth. Now, your income drives that equation, but your net worth is critically important as you begin to look to your future. So what is net worth? I'm going to define it a little bit different than you may hear it often done in the accounting world. So net worth is your assets minus your liabilities. So this is where the definition differs a little bit, and this is to get financial freedom or financial peace is what I would reference that. The definition I'm going to use is an asset puts money in my pocket every month. A liability takes money out of my pocket every month. And so that's the lens that I want to look through. And that'll be a little bit different than a normal net worth statement that you get in accounting. Here's why. If I need $100,000 coming in, that's my goal a year, then I can actually go in, if I get this number calculated, my goal becomes $1 million if I'm making 10% return on that. I'm just going to use the 10% as an illustration today. We can talk through, what's that right amount of return. I just want to try and create a framework today that we can talk through. Then we can put your specific numbers in. But if I needed $100,000 coming in a year, then I need to have a true positive net worth of $1 million, kicking off 10% per year, that I'm not worried about outliving my money. So Let's talk about assets and liabilities. I'm going to use some examples. Let's say that you had $500,000 that you had saved and put into IRAs and 401ks and mutual funds and stocks. Asset or liability? Well, as we think about that, it's in there and it's producing a return whether I go to work or not. So I would put that as an asset. By the way, on the stock market, we'll talk a little bit more about that a little later, but the concept of a mutual fund in the stock market, I look at it a little bit different. A lot of people are scared of the stock market and mutual funds. The way I look at it is it's a way for me to have millions of employees working around the clock trying to provide me a return, and I don't have to manage them. That's the way I look at business. When you're investing, you've got people that you're equally yoked with. They don't make more money if you don't make more money. And so they're actually equally yoked and going in the same place. The beautiful part is you're not the one doing all the work. They're doing that, and so it's a great way to have a lot of employees without a lot of stress. So that's one way I look about an asset there. So that's on the retirement. Another example, let's take a car, for example, asset or liability. And I'm going to go to a car paid off. Well, I'm going to put that still as a liability, even paid off, because you're going to have annual taxes, you're going to have insurance coming due on that, you've got maintenance, and so that is cash going out of my pocket every month to have that vehicle. The more expensive the vehicle, typically the more expensive the monthly cash outlay to sustain that. And so if I don't go to work and I don't have income coming in, then that becomes a drag on liability. And the more liabilities I have, things begin to own us. We don't own things. So car, I'm going to put liability. I'm going to use a second home as an example. So this isn't an Airbnb or anything like that. It's just a second home in a place that you want to go. Even paid off. I'm not going to argue that it doesn't go up in value over time, but from this definition, even paid off, I've got maintenance, I've got utilities, taxes, all those things coming into it. So if I don't have enough income to cover that annual expenses, it actually becomes a liability by definition for financial freedom and true net worth. Let's talk about a investment property. So if I have an investment property, I've got a tenant paying me every month, so there's cash flow coming in, and that's helping offset a payment or a true positive cash flow. I'm going to call that now an asset. So that's what differentiates. I've got cash coming in. It's money going in my pocket every month. Here's the big one, primary residence. So once again, I'm in the mortgage banking industry, so this one may sound a little bit off base and say, what's he talking about? Your primary residence, even paid off, is one of your biggest liabilities. Now, I'm not saying go sell your primary residence. You need shelter. You need a place to live. But here's what I've discovered. Once again, I'm not arguing that it doesn't go up in value over time, but for financial freedom, even a home paid off is still going to have expenses. You're still going to have utilities. You're still going to have maintenance, your taxes, your insurance. Let's say that works out to be $10,000 a year when you put all that together. If you don't have $10,000 a year coming in from somewhere, then it forces you to go to work. And it makes you actually work for that. Because I have a lot of people that define financial success as by the time I retire, I just want to have my house paid off, but they haven't focused on creating a positive cash-producing net worth. And then they find they don't have any income, and inflation starts to get at them, and they feel trapped. Their assets own them. They don't own the assets. And so that's why running a calculation like this is critically important. So I would invite you to take some time. Go down and work through those. If you've got questions, shoot us a message, and we can help you just wrestle with some of those concepts. Because when you can get really clear and transparent there, then it opens up more doors of opportunity for you to be able to reach your financial goals, which is really, in my mind, financial peace, that you have the option to go to work or not to go to work, or to go do service if that's important to you or not, or go travel, or have the extra means that you're not worried about. If I help my child with college, that it's not going to put me in a bad situation long-term for my retirement. So that's why this number is so important. So I encourage you to set a goal of how much you want to increase your net worth per year, because we want to be tracking and figuring out what is that right amount for you to get to live in your vision and your dreams. So I want to talk about some basic principles of financial management as we start to build our wealth. How do we go about that? And is there a process to that? I mentioned the importance of just setting and saying I'm going to put 10% of my income away. But where does it go? So some of the principles I found helpful is to talk about a concept called diversification. Now, your financial plan, we're going to talk about having licensed professionals. I am not a currently licensed financial advisor. And so if you have questions, we're going to pull in licensed professionals to help with different segments of this. Whether that's accountants or financial advisors, we want to consult and work as a team to help you achieve your goals and vision. But these are some basic principles that I want to hit on. So, for example, if I had $100,000 to be able to invest, what does that look like? Well, here's a model I've used for 20 plus years, and it served me well. So I'm going to just share this as a principle. I like to have 25% of my net worth in real estate. So that could be a few different things. So if I had $100,000, 25% would be $25,000. So that may be a down payment on a rental property. You could use that as an example. You can own what's called a REIT. Stands for Real Estate Investment Trust. It's really a mutual fund for real estate. If you're not familiar with the concept of mutual fund, is you mutually, with a lot of other people, put money into a fund. And then you have what's called an asset manager. It's a professional that goes out and with the whole is able to go purchase a lot more things. And then the piece of the pie that you put in is the returns come in, you get that piece of the return. So it's a way for you to get your money to go a lot further. So in a real estate investment trust, you're putting your money in I'm going to really categorize it kind of like a mutual fund into a mutual fund with other people. You're going to have a professional asset manager that may go out and buy an apartment complex or a mall or a development, and they'll go out with everybody's money and be able to do different things with that to make that happen. As the returns come in, you get your percentage of that. Now you can do a REIT or a real estate investment trust as just a single, what they call a private placement, where you're tied into it a little bit stronger, or you can do it in the form of just a mutual fund that you can get in and out of. I find that important to have some of the REIT in your portfolio just because it becomes very, very liquid if it's in a mutual fund-based REIT that you can trade in and out. You'll see why in just a second that's important. I put 25% in commodities. So what are the commodities? My conspiracy theorist friends, I'm speaking to you. So you finally win. It is the gold, it's the silver, it's the oil, it's the pork belly, the natural gas, it's all those types of things. So you can own that asset a few different ways. For example, you can go buy a gold coin, or you can put money into a precious metals mutual fund. What's the difference? Well, that gold coin, what is the value of it if it's sitting in your safe? Are you working it? Are you trying to add value to it? I find that owning the hard asset in this category is very inefficient. The other thing that I have sadly found is there is a lot of fraud in this particular sector because it's hard to value things. It's hard to know what's going on there. And so a lot of people will try and take advantage of assets, and people lose a lot of money in this space when they're working with assets they don't understand. But if I've got a precious metals mutual fund manager that's managing all sorts of precious metals, out trying to find ways to help that grow, whether that's going into semiconductors or all sorts of different things that they're trying to increase value. They've got the best minds in the world constantly trying to get a return on that. They manage it much better. The other fun part of that is if they try and commit fraud, somebody's going to jail. And I just love that idea, that somebody's going to jail. And so for me, it helps bring peace of mind that I've got some regulation around the asset, but once again, I can sell it easy. If I need money for something, I can click the button, it transfers back into my account. Whereas if I have my coin, now I got to go down to the local gas station typically and start to set up a table and start bartering with people coming in and out of the gas station. It's like, hey, will you buy my gold coin, and what's it worth? I mean, it's very inefficient to try and get that true value, and it's more of a bartering system. So you can, either way, you can own that asset. But my general recommendation is to get involved in mutual funds. You'll notice I have this section broken down into 5 segments. So you could go in and even diversify within that sector. Meaning, let's say that you had $25,000 there. Maybe you put $5,000 in a precious metals mutual fund. Maybe put $5,000 in an oil-based mutual fund, or $5,000 in natural gas. or 5,000 in agricultural-based mutual fund. You get the idea that you can actually diversify within that sector in a way that makes sense for you. So that's that one. The other 50% is just, I call it global equities and bonds. This is where your licensed financial advisors can break that down and get the right mix for you. I don't want to overcomplicate that. It's just mutual funds, stocks, and bonds depending on what your investment horizon and needs are. So I'd have 50,000 over here. Well, why would I do something like this? Part of my economics background is the simple principle that I know if a dollar is put into the economy, it's somewhere in this pie. It's always floating around somewhere. So let's say that the stock market is falling. Well, my conspiracy theory friends win. It really is all going to come to an end, and so the money flows to that side of the equation. And then as the stock market takes back off, it flows back over here. It's just simply a perfect hedge because people perceive real estate and commodities as safe investments, and so you have this going back and forth. Now, why would I do something like this? It creates process. See, I have people calling me all the time just saying, Brett, where should I put my money? And they've got it sitting on the sidelines. And my answer is always, I don't care. Find a process that you can actually go in and just tell your money where to go, because this takes the emotions out of it. If one sector does really good or really well over a quarter, let's say that the stock market did really well last quarter. Just set it up October 1st. Don't worry about and get on the internet and determine, well, on the third Thursday with a full moon, this is statistically the best time to trade. No, it's just create a process. Don't think about it. And so if it's just on the first of each quarter, let's say that stock fund went up and is now $60,000. That does not mean that these two sectors actually had to lose. They're probably just not up as much. So all of a sudden, I'm out of allocation in my diversification model. Well, that makes it fairly simple. All I do is I sell high. I sell $10,000 of that because that is now out of proportion. And I buy 5,000 and 5,000, and I'm reallocated every quarter. It is just clockwork. I'm going through a process. I don't have to think about it. I find that if you will just keep your money working over time, you don't have to hit all the best investments because you're consistently going in. So as an example, if you have $1,000 is your 10%, so say you make $10,000 a month, and you're putting 10% into your wealth plan, that $1,000 comes in. You don't have to think about it. You can just set it and say, well, 250 is in real estate, 250 is in commodities, and 500 is over here. And being able to just follow a process, it's really, really boring. But it allows you to actually just be consistent and not constantly worrying about, am I in the right investment? Is this going to work? Just be consistent with it, and you'll get a great return by doing what's called the dollar cost averaging. It's just you'll get some wins. You'll get where you're buying low and selling high just by consistently doing that. Warren Buffett teaches a principle that I think is fantastic, and it is simply invest in things that you know and understand. My background, my undergraduate work was in investment banking. I am very comfortable going and tearing down a financial statement from a company to see if they're undervalued or overvalued, and so that's very easy for me to do. It's a skill set I have. So I'm really comfortable with this diversification model. One of the reasons in the cases for real estate that we'll talk about is that more people I find are comfortable with a home. They live in it. They know that no, the roof doesn't blow off every month. No, the furnace doesn't go out every month. They understand that there's maintenance involved. They understand that it's gone up in value over time. They have a reference point. It's a lot more comfortable for people. And so as you start to look at diversification, I'm showing you and saying this is my model. For several clients, they are not comfortable with the stock market. It's something that's foreign to them. And so I'm not going to try and convince you that that's the place to be or that this should be your diversification model. Many of the clients, it's 50% real estate and 25 and 25. The important part is just decide what your plan is and then drive forward with that so you're not constantly wondering, man, am I allocated right? Just work through it and determine what's right for you. Because there will be a method to the madness in everything that we do here, and you'll see that as we go further into this, that we can do real estate on purpose to get our diversification and desired outcome. So back to the investment cycle of buy low, sell high. So what does that mean? Most people look at it and say, well, I do that. Yeah, I can. That's how I do it. But this is much more difficult than most people think. So I mentioned I'm comfortable breaking down a financial stock and moving forward with making that decision. So here's what it really looks like. Let's take the cuteness of that out. My wife, her name's Chayla, and so if I come home and said, Che, hey, I found this stock today, this company that we should buy. Oh, really? Tell me more about that. She probably wouldn't say that. She doesn't care. But as we go through that, if she's looking at it saying, tell me about it, here's what my answer is. Well, everybody thinks it's going to go bankrupt. How does that feel to you? That's a little scary. Here's what it really means to buy low. But if I look at it and say, everybody's betting, saying that it's going to go bankrupt. But they've got a new management team that was just brought in. They got a cash infusion and 2 new product lines. And when I put all that into the equation in the cocktail, it's telling me we should buy this. It's low. And this is going to turn. Well, when it's your own money, if I look at it and say, Che, I think we should put $100,000 into it, when everybody's betting against you, you can't do it. Emotionally, you can't do it. And so those that actually understand what they're doing typically buy right here when their assumptions are validated and it starts to come back up. And now it's been doing great for the last 2 years. Everybody now wants it. It's the big hit stock. It's all over the media, news. Everybody's trying to get into it. And the numbers are saying you need to sell. Now, on that, sometimes we overcomplicate what's going on. Some people think it's going down because it's a bad company. No, you're always going to see this going on with markets because a company kicking out a certain amount of earnings, if they get a ton more money coming in and they can't kick out more earnings off of that, it doesn't mean that it's a bad company. It's just they got way too much money that can't provide the return on earnings there that was going at the same level. And so it starts to correct back down, and then you always come back and forth in this equilibrium. So the numbers can tell you when to get out, but if it's been awesome for the last 2 years and now everybody wants it, emotionally it's hard to sell it because you're asking yourself, what if I'm wrong and it goes up another 20% next year as an example? And so you don't sell it until it comes back down and your assumptions are validated. So the statistics show that those that actually know what they're doing average about a 4.2% return, and it's just because simply they have emotions involved. So this is one of the principles of getting professionals involved. You may relate to this. I've got a client that I think shares a story, called me a few years ago that you may relate to. He was working with some of our financial advisors we had referred them to, and he called and said, Brett, I don't get it. The financial advisors called and they're telling me to buy this high-risk, low-return mutual fund that's just been a dog the last 2 years. I don't feel good. I found this one over here on this other investment website that's been returning 20% for the last 2 years. I want to buy that one. You may relate to that. It just feels better. And this is often how people invest, is they're going by what they feel. Well, you may have grown up with a similar term that I had heard, and it was this: Brett, don't invest money you don't have to lose. I've thought about that through the years. Why is that even an idea? Why would I invest money if I'm expecting to lose it? Well, it's really here. Most people go by their feel. They look at what everybody else is doing and say, hey, the market's really come up, this has done so well for me, and now they're putting in and not getting professionals involved, and all of a sudden they're up here, they're buying here, and it starts to go down. Not that it was a bad stock, bad mutual fund, it's just now everybody put their money in it and it's correcting down, and all of a sudden they look at it and say, oh my gosh, the conspiracy theories are right. It's really going to go to zero. And they get worried. And so they determine, I better sell before I lose it all. And that's a pattern that most people get into. And so I think it's very important to have professionals in your corner. Now, to me, a great financial advisor and a financial coach has the heart of a teacher. It is your money. That's something I encourage people to find when they're seeking out financial advisors, is that you can articulate your vision when you want to have it, and then they can help teach you a format and create a strategy to help you get there. But hire licensed professionals. That's true if you're buying real estate. Get a licensed professional involved that has lots of experience of evaluating properties. I encourage you, as you're selecting real estate agents to represent you in buying properties, ask a simple question. Do you own real estate? That's a big differentiator. If they have experience and have been managing their, or involved in real estate in their own portfolio, they come with a different skill set and expertise. It's not just about the fun of going and buying a house. They think differently. They look at it differently. As you look at financial advisors, is this a plan that you follow? It's a great question to ask. As you get into investment properties, are you using professional property managers? This is where I find most of the time people aren't managing a property like a true asset. Their feelings start to get involved in it, and it may look something like this. Well, I don't want to raise the rents because the tenant's been there for 3 years. They've been fantastic. If I kick them out, or if I raise the rent, they're just going to move out, and then it's going to be vacant for 3 months, and then I'm not going to be able to find anybody. And all these things start emotionally to go through your mind. But if you have a professional property manager that is all their business plan is out finding people to rent properties, they probably have a list of 500 people waiting to get in that property. So they don't make it about the emotions. They send out your annual increase and say, hey, rents are going up 4 or 5%. The tenant has a decision. They can move out or they can pay the increase. And the property manager doesn't have the emotions involved of all these stories going on in their mind that they're looking at saying, we have a ton of people ready to go to move into this. And so they're running it like a business, and that will provide you a much better return over time. And so this is the principle of hire professionals in all these different areas of your life. Interview them, get comfortable with them. They should be able to communicate with you in a way that you understand. No one should ever make you feel stupid about how you're using your money. I think that's important as you're looking out there. They should be educating. Of course, they should have the courage and to be able to hear what you're telling them you want to accomplish. But if you're not getting there and you've got the wrong roadmap, of course you want a financial advisor that can pause and say, based on what you're telling me, I don't know if you were in the right vehicle for going the right way. And they should be able to help you get clarity in the path to help you achieve your goals. So this is some basic framework that I hope will be helpful for you in looking at what is my plan, what is my strategy. Once again, reach out. We want to be able to talk to you and hear what your vision and goals is. We can help line you up with great team members and professionals in all these different areas of expertise all over the country and be able to help point you in great directions to get your path started. So that's some framework. The next thing we're going to talk about is really the case for real estate. So we'll break and go to that now. Alrighty, let's talk a little bit about the case for real estate. So one of the first principles that I mentioned earlier is invest in things that you know and understand. So it is a great tool and asset to be able to buy. Now, one of the principles of real estate, I often get asked the question of how or when do I buy it, Brett? Well, buy real estate and wait. Don't wait to buy real estate. Time is your friend. And so people ask me all the time, when should I buy? The answer is always the same for me, when you can afford it. We don't want to do anything that's going to put you in jeopardy, but often you can afford more than you think that you can by getting professionals involved that see a bigger picture on how to make this happen. We've done it for over 2 decades. And so we can help create a lot of vision that maybe you can't see as professionals once we understand your vision and what you're trying to do to get there. So the 4 returns of real estate, that's where I want to talk a little bit and just create some framework around real estate. So return number 1 is cash on cash. Let's say, for example, you have a property that you have $2,000 a month coming in rent and a $1,500 a month mortgage payment. That $500 difference between there is income or your cash on cash return. That's return number 1. Return number 2 is appreciation. So let's say that you have a $500,000 property that appreciates 5% next year. That increases $25,000 in value. That's 5% on the $500,000. So your property next year is worth $525,000. Remember, we started talking about increasing your net worth. That increases that net worth. And so that's critically important to your long-term financial plan. The third is principal pay down. So as you have, use that same example, I've got $2,000 a month coming in rent. I have a $1,500 a month payment. Well, $300 of that payment is probably principal pay down. The beautiful part about this is that the tenant is paying down your debt on that, which increases your net worth. And that makes real estate really fascinating. I just pause there and give an example. Putting money proactively into your 401k, you're putting that money in. You may get a match from your organization, or putting money into an IRA or a mutual fund. You're putting all that money in. One of the fascinating parts about real estate is that someone else is funding and paying your asset down and creating your net worth. So really fascinating on the difference there. And then the fourth is depreciation. So I want to talk a little bit about each of these in a little bit more detail. The cash-on-cash return is pretty straightforward, but there's some interesting components to that. I'm going to break down and run you through some income statements in a little bit on this. But most often, your cash-on-cash return when you're starting out is, if you're lucky, break even. Sometimes it's even negative. So let's talk about if that was negative $200 a month, most people will look at it and say, don't buy. Remember when I talked about in the beginning, if you have a vision of where you're going, if you're just focused on that one thing, it may cost you something. And so we'll talk about how that changes over time when I get some examples up to illustrate that. But on cash, that does not always need to be positive, because you've got the three other areas that can help you out. Appreciation. Now, this is a really fascinating one. Property values go up over time. Think back on your life experience. This is one you can have quite a bit of confidence in. As you look back, values have gone up over time. It's because people want that. Maybe on the appreciation, share a story that I think is relevant on how you create appreciation. I was asked to teach I teach financial literacy in several Title I schools here throughout Utah, in the high schools, but I was asked to come teach a group of 7th graders last year about why I do what I do in my career. And I thought about that as I went. I was trying to teach them some financial principles. Here's what I came up with. So as I went into the class, I was trying to explain to them, why do I do what I do? And so I asked them, what does home mean to you? And as I listened to their answers came back with things like this. Well, it's where my family is. It's my safe place. It's where my Xbox is. It's where my cat is. It's where my friends can come. That was home. Why do I do what I do, and why do I love the mortgage banking industry and just being tied in all things housing? It changes society. It changes society. It changes your life. It provides more security. Crime goes down in neighborhoods as people own assets that they care about. People get more engaged in their school systems. It's just, I love what I do because I believe it's changing society. And so I was trying to explain this to these 7th graders. Now, phase 2, I asked them this question: what does appreciation mean to you? As I saw their curious little minds working, they were sitting in little pods of 4 with four buddies there. And as I asked them, what does appreciation mean to you? They answered it. They said, well, it's to be thankful. I said, that's correct. So if you're thankful and you appreciate your 4 little friends sitting there, what does that look like? They started to give me answers like, well, I'd share my lunch with them maybe. I'd invite them to play at recess, or I'd invite them to my home. I'd say nice things about them. I said, that's correct. What happens to your relationship over time if you appreciate each other? Well, it grows and gets stronger. It's an economic principle. So I asked them the different question: what's depreciation? And at that point they said, all right, we lost you, old man, we don't know. And so I said, well, it's the opposite of appreciation. And so if you've got your 4 little buddies, what if you start to talk bad about them? You're mean to them. You fight with them. You don't invite them over. And you really exclude them. What happens to your relationship over time? Well, it goes away. That's depreciation. And that's an economic principle as well. So one of the fascinating things about home ownership, people appreciate what those 7th graders described as home. The emotional desire to have home. Security, safety, where my family is, my cat. They will actually fight for that, and they will live in division for that. And that actually puts incredible demand on housing, which pushes those prices up because people appreciate it. And so there's an economic principle when you look at, is the stock market going to go up? Is housing going to go up? That's a powerful, just simple way to look at it because I think we all relate to that feeling and desire to have home. Principal pay down. That one's pretty straightforward and self-explanatory. As other people are paying that down, that increases your net worth. The 4th one, depreciation. Now let's talk about this one for just a minute. The basic concept of depreciation. Once again, you will want to consult with your tax advisor on this. These rules are very different whether you're a qualified real estate investor or not, and how you take deductions. So I'm just going to talk about the principles and the theory here to give you an illustration. Let's say that you have a home that's worth $400,000. Is what you do is you take the value of the land out of that. Let's just say that that's $100,000. That leaves us with $300,000. On a single family residence, they're going to take that $300,000 and divide that by 27 and a half years. That's going to work out, let's say that's probably roughly $10,900, $11,000 range in what that breaks down to. And you now get to take that as a deduction on your tax return, which means your taxable income goes down, reduces the taxes, means more net income into your pocket you can now go put to work. So that's one principle. Commercial real estate's over a 39.5-year period, I believe, off the top of my head. But there's also, you can do what's called a cost segregation. So let's go back to our scenario. If you have a house that's worth $400,000, $100,000 is the land. We take that out. We have $300,000 left. Well, you can hire a third-party firm to come in and segregate or segment the rest of that property. Just give you some examples. Once again, this will just be principles. But let's say that they come in and say the carpet's worth $20,000, and let's say that the electrical is worth $30,000, and you get the idea. They segment this home down. Well, the IRS allows each of those categories to be taken at different depreciation schedules. Some 3 years, some 5 years, some 7, some 15, and then the remainder that was left that wasn't able to be accelerated would be left on that 27.5-year term. So let's say that one of those items was $30,000 over a 3-year period. Now you can take $10,000 a year 1, 2, and 3, which accelerates that whole 27.5-year breakdown. And so this is a tool that you can use to be able to help get some very, very significant tax deductions right now to help lower your tax bracket, get a lot more cash in your pocket that you can go put to work to help accelerate your wealth plan. Once again, it's very important you're talking to a tax advisor and accountant on this because there are limitations on whether you can take that full amount year 1 or not. And so this is something you'll want to talk through, but I just wanted to give you the basic concept so you have a framework to be able to at least ask the right questions if it applies to you. So one of the other principles I'll hit on is a lot of people ask me, Brett, what do I invest in when it comes to real estate? And so, you know, you're here today, why not just have a good pyramid scheme? Everybody loves a good pyramid scheme, so why not hit it today? So here's what I call the pyramid of real estate. Here's what I found and discovered. Typically, your highest and best return over time is going to be a single-family resident property. So that could be a townhome, that could be a single-family home as an example. And you'll see why in just a second. The next one is multifamily. So that's your duplex to 600 units, whatever you want there. So that's multifamily. The third one is commercial real estate, and then the fourth one is really land development. The reason I point this out is just as principles that I found over time. The further you go up this ladder, the more technical it gets. It takes a different skill set. People are familiar with how a single-family home works, and they've lived in one. Each one of these you handle differently the way you manage it. There's different complexities of how you calculate square footage for leasing it out. And once again, it takes a lot of different complexities. So for example, on land development, you may buy it and think, well, I'm just going to tear straight into this. Well, what if your community doesn't like what you're trying to do? And they hold you up for 4 years, just trying to battle through getting that project off the ground. Well, there was carrying costs on that. You were paying interest and loss of time, and that may take all your return and take it right out. And so doesn't mean don't be a land developer. It's just that this is typically what I find in the complexity. Your risk goes up if you aren't trained and qualified for that. So become a student of real estate if you're going to get into those different categories. But why does single family typically work out the best? Well, it's actually back to my 7th grade scenario of appreciation. For these three, multifamily, commercial, and land development, value is typically a numerical driven increase. So if I want to increase my value, I need to increase my net operating income. So that's going to be upping rents. Maybe it's renovating a property, getting those rents up and trying to drive net income, and that will drive that value up. So it's something that you can do forced appreciation. If you know what you're doing, it can work very, very well. But it doesn't get that natural appreciation. I own several commercial properties as an example. I have employees that come to work there every day. But if I were to look at it, I want a nice place for them to come that they enjoy being at, that's comfortable, they're spending time away from their family. Well, let's cut to the chase. If they had the place to spend, or where they wanted to spend all their time, it'd be a home. They appreciate it different. It's not that they don't necessarily appreciate where they're at, or an apartment complex. As I look at tenants in apartment complexes, they're grateful to have a place to live, but most of the time they're talking about, how do I get my own home? How do I get that piece of safety where I control it? I'm not worried about the landlord increasing the rents on me next month or moving me around. I can take control of my life. So people appreciate single-family homes and townhomes. Why is that important? If you're a real estate investor, own what they emotionally want. That will create an emotional sense of demand, where these other ones are going to be very business driven that you can force. But typically when you put that emotional appreciation in, that's why I believe and have seen that typically that single family townhome is your best place to start as you grow in your real estate understanding, and typically your best return over time. So with that, we're going to start to break and get down into some technical analysis of how do we find properties and markets to invest in, how do we break down cash flow statements, all those types of things. So we're ready to break and look forward to going through this next segment. Before we move on to the next section of the presentation, I wanted to invite you to take the next step to get started. Your journey to financial freedom begins by you taking action. You can get things started by contacting me now. I can be reached by phone or text at 801-628-6771 or by email at brett.mills@guildmortgage.net. Remember, there is no cost or obligation to you. Let me help you achieve your financial dreams. Alrighty, in this segment, I want to talk about really how do you break down a market? Because that's a common question that people ask is, where should I invest? Let's say that you've concluded that you're curious about real estate, and so where should I invest? Most people, once again, sit on the sidelines looking for the exact perfect place to be able to, in their mind, invest. Do I go to a cheaper market because cheap means good? No. I want to teach you how to go through and create a process around breaking down real estate. So one of the tools that we look at is I like to look at the bones of an investment. If I'm looking at a stock to buy, I like to look at the foundational principles of an organization. Do they have a strong business strategy and plan? Do they have a proven track record? Do they know where they're going? Do they stick true to that vision? Do they have the capital to get there? Do they have the right talent to get there? All those things become economic factors that I look in to say, is this a good investment? Well, we should use the same type of due diligence and prudence when looking at where should we select an investment property to buy. I come back to that principle. With real estate, it's actually pretty difficult to mess it up. And so, once again, buy real estate when you can afford it. Buy real estate and wait. Don't wait to buy real estate. So I'm going to give you an example. This is going to be a couple of counties in Utah. We can pull this information for you anywhere in the country. This is one of the common questions I get as I go through this. Brett, this is really helpful information. How do I get access to that? This is a subscription-only service, and so we're happy to help get you this information. As you're curious about different markets, our team can help get that put together and over to you, and we can learn what your goals and strategies are, because a lot of times it's going to be working in a market that's close to you that you're familiar with, and that's fantastic. So we can help kind of evaluate that. So here are some of the bones or the themes that I look at in a market. So I'm going to start here in Weber County, Utah. I see here that the median house price in Weber County is $442,827. That's an important factor. One of the reasons that's an important factor is that helps me set a process around where to buy. Now, I may ask locally here about certain cities in Weber County and ask someone, would you want to invest in that city? And there are certain cities that many people would say, no way. But that's emotional. You can actually help make an educated decision and get more to a process around where to invest in different price points and communities. So if I go into Weber County, and my suggestion is that that you actually select 20% above or below that median house price. That gives you a bandwidth. Now, why would I do something like that? What do I want if I own a rental property? I want people that can pay rent. I want good jobs. I want people who have stability in income. And they also are typically pretty interested in having a place that you would want to live. I want a rental property to be something that I'd be proud to live in. And so if I use that as an example, if I go and say 20% above or below $442,000 in Weber County, that gives me a bandwidth that really about 80% of all the people in that area, because of median incomes, can afford to rent that or to live there. That's what I want to know. If I go and invest in properties that are $2 million, very few people can afford to be able to get into that property sustainably because there's just not enough income. That's going to affect the demand on that property. And so I just want something really boring that a lot of people can afford as I'm looking at. On the flip side, a lot of people say buy cheap. Well, to me, cheap does not always mean great investment. I can find properties in Weber County, for example, for $250,000. I'm way below the median house price in that area. Well, by virtue of that, that's normally where I'm going to find tenants that probably aren't as credit qualified, have less stable jobs and income, and bring a whole other of demographic and social challenges to that potential property as tenants. By having a process and just saying, hey, in general, I'd like to stay 20% above or below a median house price, allows me to go into any particular area and say, there are great communities in almost every city that are worth buying and getting into. So that's a principle and a process, and you'll see this change as I look at a couple of counties. Here, and once again, we've got this data nationwide. So another one in here, this shows the historical appreciation rate. So over the 5 years, 10 years, and 63-year appreciation rate. That also goes in, and based on some economic factors, it's taken that median house price of $442 and saying over the next 5 years, it's anticipated that will go up $112,000 or 5.09% average per year based on some of these numbers we're going to look at next. And so that helps me get a feel for, hey, what is that going to perform like? Now, if I go down here into the affordability, there's a couple of components that are important to me in this particular section. One is area median house, or the median household income. So in Weber County, that's $92,506. The national average is $80,630. So therefore what? Well, I like to look at unemployment trends. Unemployment is really low in Weber County. Wages are better than the national average. Why is that important? Well, if I own housing, I want as much demand on that as possible, because that's once again, that helps drive my rent prices up over time as well as my appreciation. So if you have people across the country that the unemployment rate is higher, and let's say their median wages are below that, or that the median wage in that community is below the national average, and they've lost their job, everything's on the table. Often, it's just not the population growth within a market, but they're looking at saying, hey, if the median wage is $55,000 in the area they live, unemployment's higher, where are the jobs and where are the good wages? If Weber County has them, people will migrate there for opportunity, which creates more demand on the thing that I own. And so that's important to look at those types of things. The affordability index, this here is a really interesting number. So the affordability index takes in overall affordability from food costs to housing costs, just all those things that go into maintaining a lifestyle. Well, the national average in this metric, so you understand what we're talking about here, is 100 on that score. So as what this would mean, you can see over time that 100, the national average, Weber County has historically been much more affordable than the rest of the country. Right now it's 90, it's starting to trickle back up. So as what that means is it's actually 10% less affordable than the rest of the country as a place to live when you put all the factors of life. Well, that's a consideration I want to look at. I have to weigh that out in my mind. Is that a good trend? Well, trends are coming back up. You can see the effects of interest rates, how that affected everybody in the nation and over the past couple of years, and now that's starting to trend back up on affordability. Well, that's important to me. Why do people leave a lot of the coastal areas? A lot of people argue and say, well, it's about the politics and everything else that's going on, or society. You know what? I love the coastal areas, but it's a beautiful place to live. Great amenities. But the reality is that a lot of their affordability indexes are down almost close to 30. They just can't afford to live, and so they're moving to places where their dollar can go further. Where do I want to own real estate? where people are migrating to. And so that's one of those factors that I look at. Another one here that I think is helpful is your homeowners versus renters. So in Weber County, there's 198,000 homeowners. We have 74,000 renters, and then almost 19,000 renters who can afford to purchase, but they're listening to their mother telling them it's too expensive, you can't afford it, so don't even try. That's that group. And so they don't even try to go after it, but this is important because this becomes potential renters, and that creates demand on something that I own. There is more information on this graphic that's helpful, but that's the main area I wanted to focus on. So I want to highlight something as I look at rental properties. This here, we have almost 90,000 renters in that market. That's a lot of demand. So that's something, if I'm looking at vacancy rates, I can probably look at it and say, hey, if I have a tenant move out, there's so much demand on it, it will probably rent immediately. That's one of those things that I just try and think through. So I'm going to move to a neighboring county in Utah. And this is where analysis paralysis can kill everybody when they're looking at every single market out there. Once again, we'll help get you data because I just want you to be able to think through what the opportunity is. So this is in Morgan County. It's right next to Weber County. So all of a sudden our median price jumped from the $441 up to $567,000. So it does cost more to live up there based on the housing costs. You can see your appreciation rates, a little different over time. Your 5-year appreciation looks somewhat similar. It's forecasting at about a 4% based on the economic data. But I'll give you an example here. The median household income is higher, so about $138,000. Still your national average $80,000, so people are making more money on average in that market, which drives that price up, is what you'll find. Your affordability index is actually showing higher up there, meaning it's 8% more affordable than the rest of the country to live in Morgan County. So that's a good trend that you're looking at. Now, down here, this is important. We've got about 11,000 homeowners, about 2,300 renters, and then the 600, so you're about 3,000 renters in that market. Now, I can look at this. I happen to live in Morgan County. So this is what I talk about, invest in things that you know and understand. Well, I know that some of these statistics are kind of skewed up there. The values are running much, much faster, much, much higher. And so I know that the appreciation is probably going to be higher. It's showing based on these numbers, well, it's a smaller population. It's showing the appreciation forecasted at 4 versus 5%. 4% up there, 5% in Weber County. But I know as a local person that actually appreciation is going to be stronger there. So that may be a consideration why I would want to buy in Morgan County. Well, as I look at this, why would that number be important? Doesn't mean maybe my appreciation gain is going to be greater in Morgan County, but there's not as many people. So meaning that if my rental goes vacant, it may take me 3 months to get that filled back up. There's just not as many people there. And so that doesn't mean don't buy a property in Morgan. It's just when I go into it, I may want to build into my model a little bit longer on the vacancy factor as I'm looking at a property there. So I hope that's helpful. There's not one perfect place to invest. Pick a place that you're familiar with. If you are seeing market opportunities, very seldom are you going to go wrong. And so jump in, and when you can afford it, and we can create that path forward. So that's some example on some economic data that I like to look at as I'm evaluating markets. Now I'm going to transfer that over, and let's look at how that translates into an income statement as we buy real estate. So I'm going to go back. I'm going to use Weber County as our example. So let me go down and pull this up here. Once again, we can pull this all over the country. And if you have questions, I'm going to be running some numbers. You'll be saying, how do I get my hands on that? One, we can run them for you, but I actually do have calculators and spreadsheets put together that if you want to reach out to us, we can, once again, find out your situation. We can get these materials over for you that you can begin analyzing properties in your local market. So what I've done here is I went in and I selected in Weber County a property to buy for $450,000. Now, here's something that I look at. Once again, that was really close to that median house price. That's kind of a great spot to be at. So renting, based on all the economic indicators, our system with the economic poll, it's suggesting that market rents in that area for a $450,000 home is about $2,853. Once again, being in the local market, this is why you would want to get a local partner involved. I'd want to talk to a local real estate agent. I want to talk to a local property manager. They're going to know that's what the system's forecasting, but now we can kind of change this as we're running our income statement. I'm going to go in and say, I think that's a little bit high. I'm going to change that to $2,700 a month. Now, you remember, there is a ton of demand for rentals in Weber County. There was, I think it was almost 90,000 people trying to get a rental. So based on that incomes, it's forecasting those rents to grow at 6% over time. Once again, we can change this and force it to whatever you would like on that. We can change the vacancy. Once again, because there was so much demand, I'm leaving that vacancy almost at 0. I may, in Morgan, that's where I can change that in this model. So I'm going to look at it and say, okay, $450,000 purchase. It's got a property taxes in here. Homeowners insurance is just a little bit high on that. If it's a townhome, I can put in a homeowners association fee. This will vary by markets. This is where you want to talk to local experts. For example, in Weber County, it's common and typical that the tenant will pay the HOA fee. So I wouldn't want to put more an HOA fee in there if the tenant's paying it, as an example, because I'm going to be double dinging my expenses. And so that's just understanding your local market, whether you typically pay for that as a landlord or them. Now I'm going to get down here. This is going in on a maintenance factor of about $187 a month is what it's suggesting based on a home in that price point of what you should be setting aside to take care of just ongoing routine maintenance. And so that's important. If you've got a property management fee, you can plug all that in here, and then a cost to sell. Now I'm going to come down here and show, say, I'm putting 20% down. So that puts me at a loan amount of $360,000 on a 30-year fixed rate. I'm going to say today is at 7.125. This is where it's important. Reach out. We can get you those numbers. There is not one investment property number out there. This is where we need to understand your situation. We have hundreds and hundreds of different programs and investors. This is where so many people miss their opportunities, is they're not calling and reaching out to us as professionals to understand their situation. How do we help you get into the most affordable and cost-effective way to buy that? And so don't just assume and jump online and say, well, here's an interest rate I saw, let me plug that in. Let's just create your path. It takes all the questions out of it. There's no charge to do it. We do a soft credit pull when we pull that up front just to analyze the situation, so it doesn't even hit your credit. And then we can hear what your vision is and create that pathway. So please don't delay and say, man, let me try and do this on my own. We talked about that earlier. Investing on your own without professionals involved typically leads to a very poor outcome, is you're overlooking a lot of opportunities. So I've got some closing costs in there. And then this last screen on the homeownership, this is just simply taking that, it's showing a forecasted appreciation of 4.89. That was based on that last real estate report card that we were looking at. So those are my inputs. Now I have an income statement. So I look at my cash flow. Year one, my gross income is at $32,400. My mortgage payment is at $29,105. Property taxes, insurance at $4,200, and then my maintenance and repairs at $2,244. So my expenses at $35,000, and I'm a negative $3,156. My cash-on-cash return number one, is a negative 3%. So here's where most people stop. This is why they never buy it, as they look at it and say, oh my gosh, I don't want it to cost me $263 a month if I break that down to a monthly basis. I'm just not willing to do that. And they stop. There are 4 returns on real estate. This is where real estate becomes really, really cool. We need to look at all of them, because if you're living in a vision, I mentioned it's going to cost you something. So let's look at this trend over time. This is showing your loss, so that gets better over time. Why? Because rents are going up. If you've bought the property, you fixed in your price. You fixed in your interest rate. You fixed in your costs. And so as that goes over time, your rents go up and you get into a positive cash flow. That's understanding the time value of money. Now, maybe in year 2 or 3, let's say that rates are always doing this. All economic principles, they're doing this all the time. If all of a sudden they drop 1% or 2%, and we have the opportunity to refinance, we can actually lower that payment down and get cash flow even stronger. And so that's as we look at that over time. Just because it's negative day one does not mean it's always going to be negative. You have to be able to look with vision into the future. Return number 2 is your appreciation rate. So it's forecasting 4.89. Just for some simple numbers, I'm going to use around 5%. So 5% appreciation on $450,000 is $22,500 a year. So that means it would be worth $22,500 if that assumption holds true. Well, that's your second return. Now remember, to buy this, you're going to have to put 20% down, which is $90,000 out of pocket. Okay, let's start to compare that to some other investments. Let's say that you have $90,000 in a mutual fund that makes 10%. Well, that's $9,000 is what that return or what it grew by that year. Well, on the real estate, you put $90,000 to work of your money, but if it made $22,500 based on that appreciation on the price, that's a 25% return as you take your $22,500 in appreciation and divide it into the $90,000 you put to work. It's a 25% return in that category. Then you have your principal pay down as the third one. Why, when I melt all this together, it kicks out a return of 16.9%. Even with the negative cash on cash return of 3%, I am still up because I've melted all these together and I'm at a 16.9% return. That doesn't even put depreciation into it. Those are the 3 returns. And so now we can start to look and say, how does that compare to how I'm doing in my portfolio? Is this a relevant diversification tool I might want to consider? That's for you to decide. Now I want to show you one of the most powerful things of real estate that's very, very counterintuitive. Most people are saying, Brett, how do I get to a positive cash flow position? Well, let's go in and let's change a couple variables. I'm going to move this to 30% down, get a little bit better interest rate, say that that goes to 6.875, and these are always changing, guys. So this is where you want to be able to reach out and let's see what your custom scenario is. Now I've got my income statement. My rents were the same. My payment's lower because I'm financing less and the interest rate was a little bit better. Taxes, insurance the same, my maintenance the same, but now I get to a positive cash flow of $11.17 a year or $93 a month. Well, that feels better, right? That makes us smile. We feel better about that. So I'm positive 0.8%. Well, what happens to my return? Most people intuitively think, well, it's going to go up. Well, it dropped from 16.9 to 14.2%. What in the world is going on here? Well, here's the power of real estate. For this one, you had to put $135,000 of your own cash to work to get that same return. Now, appreciation, because you put more money down, the $135,000, did it appreciate any faster? The answer is no. That $450,000, if it appreciates at 5%, is still $22,500. So instead of dividing that $22,500 into 20% down, the cash you're putting to work, into $90,000, you're now dividing it into $135,000. So my return on appreciation dropped from 25% to 16%. So even though my cash on cash got better, my overall got down, and it's the principle of leverage. You may have heard this. Now I'm going to go to the unicorn that everybody buys real estate for and wants to go to. I'm just going to show this. Basically paid off with $1. And now my positive cash flow is at $21.62 because I've just got my taxes, insurance, my maintenance. My cash on cash return is a positive 5.6%. I've got my cash flow rolling in. This is what we wanted. We see that going up over time. But now my overall return just dropped to 8.6%. And the principle is that it's still appreciated at $22,500, but now I have $450,000 sitting there. So what's my return on equity? It drops dramatically. This is the concept of leverage. So why do I share this? The math will almost always, I'm going to say not always, this is where we need to evaluate the products and the properties. Sometimes it doesn't make sense, but the math will almost always tell you to use leverage. It allows you to get to your financial goal a lot faster. Well, that scares a lot of folks when you start to look at using leverage. So we should have a purpose to what we're doing. If you own multiple properties, your appreciation grows a lot faster. If you have $1.5 million in real estate, that is going to grow at 5% appreciation. That $1.5 million, instead of the 450,000 that grew at 22,500, if you have 3 properties at $1.5 million that grows at 5%, that's $75,000 a year in appreciation. So the leverage allows you to actually get into a lot of properties. Now, as we look at strategy, we always start with a purpose in mind. I mentioned the example of, let's say that you decide $20,000 a month, $240,000 a year is what I need coming in, which means if I'm using a 10% return, I need my net worth to be $2.4 million. So that's how we just stack that up. That's your goal. That's what you're trying to target by your defined date. So if we get there, and let's say that you want 50% of that in your diversification model coming from real estate, well, that means $10,000 a month in cash flow needs to be coming from your real estate portfolio. If I get there, now I know that roughly in this market, and it'll depend on the market, we can run those numbers, you're going to need 5 homes to be able to generate that income. So the math will tell us just keep leveraging and buying properties as long as you can, but that's just going with the current and because we can. Let's use a strategy. If your number is you need 10,000, then let's use leverage to get you to your 5 properties and then let the cash flow pay them off. That's what living in vision and having a path does. It allows you to move with clarity. Take some of the scare out of using leverage. You want to use appropriate leverage that's affordable as you go into that, and you can reach your goal much, much faster. As you look at properties like this, there's a different answer for everybody. Sometimes you have plenty of room in your cash flow to be able to fund that and go negative. Some people are going to say, well, I can't do that. Well, let's say that you're putting $2,000 a month into your 401k and your IRAs, and you're saying, I don't have any real estate and I want to diversify into that. Let's say that the negative cash flow on a property is $500. I'm not saying abandon ship on your 401k and IRA, but could you just lower your monthly contributions from $2,000 to $1,500 into your 401k and your IRA and take $500 into this so that it's growing and you're reaching your goal much faster? That's really important as you look at that. So that may be one strategy for one person. Another may not be able to afford any negative cash flow, and so that's where we need to look at and say, how do we get the numbers to a break-even or positive cash flow? That may require a little bit more down, and that's okay if the return goes down. If we can help you just buy real estate and wait, don't worry about buying it with maximum leverage and being scared every month going into it. So this is where we want to create a custom plan, understand your concerns, your goals and your vision, and how aggressive you want to get on something, and we can create a plan that will adapt to you and your ability to move forward. So that's really, really important as we look at real estate, is everybody has a different place they're in, and we can help you kind of navigate that and get the sweet spot for you. So I hope that's helpful on understanding the different components of how to break down a property. Now, where do you get your cash down? That's probably one of the biggest questions that I get. That's where we want to be able to talk to you. There's so many ways to go about that. Just some general ideas and concepts. Maybe you do have $400,000 or $500,000 in your retirement plan. Do you pull some of that out? Talk to your financial advisor. A lot of the times the money that you have put in you can pull without penalty. The growth and the earnings and matches, of course, you're going to take a penalty. But every plan is unique. Talk to your financial advisor if it's a diversification, and we can talk through if that's appropriate. That's one place you could look at it. I'm not saying sell your whole portfolio to do this. Let's diversify. Another place that perhaps you are pooling funds with a couple of people to get in and start. In general, if we can find a way to get this to work for you, I'm an advocate of trying to find a way for it to work with you. And people are surprised how often we can discover a way for you to make this happen. Sometimes it's creating the pathway and saying, okay, here's what you need to do over the next year or 2 years to get there, but we want to be intentional in this. Partnerships work if you don't have a lot of other options. I found in real estate, one of the only ships that doesn't sell is a partnership. And that's simply just because you're never equally yoked to your business partner. They're going to be in different financial positions. If you're needing to put money in to renovate a property and they aren't in a financial position to do that, you get conflict, and that gets hard. And so if it's your only way to get into the properties, sure, understand the risks going in. There's ways that you can structure that with agreements that will help make that more feasible. And we can talk through different structures on that would be helpful if that's of concern to you. Also, how to hold the properties. That's a different discussion that we can get into that may be unique to your circumstances, that we pull in great qualified accountants and attorneys to make sure that the structure is proper for you. But there is a lot of affordable ways to buy that. So back to this cash down payment, that $90,000, often you can actually pull the money out of your home. This is really fascinating to me because as I look at it, I've got people, now remember in here, I've got the interest rate in here at 7.25%. But Brett, that's a really high interest rate. I don't want to pay that. I'm going to wait until interest rates come down to buy. That's often what I hear. Well, if interest rates come down, what happens to the prices of the homes? They skyrocket. And you missed your opportunity. If you bought the property, then you're able to lock in that price, and as interest rates come down, you lock in the next part. That's why you have to buy real estate and wait, as it creates these opportunities as you go along. Waiting for property prices to fall, they're not going to, guys. That's appreciation. So as you look at that in your own home, I hear so often, Brett, but I've got an interest rate that's 3.75. I can't let go of it. Well, that may be true. There's lots of ways we can access that equity. Perhaps it's doing a home equity line of credit or a home equity loan. Perhaps it's refinancing your whole pile of money. What if we went from 3.75 and that went up to 6% to get the money out to create 1 or 2 down payments on properties? We'll put that into the cost. Once again, if you're only focused on the cost, you'll never see the opportunities. That is really, really important. And this is where I think without having a professional involved that's not stepping back emotionally and saying, here's what you're describing you want to accomplish, well, we need to look at the whole picture. And that's where I think getting a third party involved can really be helpful, because I'm going to look at that and say, okay, I hear you. You've got this great low rate on your house, and that's important, but is that going to create true net worth to allow you to be financially free? If you're living a vision saying, man, I'm not going to make it unless I do something, well then let's empower you and help you see that pulling some of that money out and putting it to work and getting a return on equity there with purpose, not just to go and to leverage, but to help you get to your goal, and then we can start to have the properties pay that off. It's really incredible. So there's a lot of ways to get this down payment, and so we can work together. There's all sorts of different programs that have different levels of down payment. You can put less than 20% down. That seems to change from time to time depending on what's going on in the financial markets. I've seen it as little as doing 10% down. Sometimes it's buying and moving out of a property you're in and moving into a new one as a primary residence for a year, and they can get it in with almost no money down. There's so many strategies we can work through depending on how you want to build your portfolio, but we just need to understand what your needs are and help you grow into that. Now, why does this all become important? I'm going to show you an example here that I hope will be helpful as we model out. So let's say that you're coming in to retire and you're saying that I need $240,000 a year, I mentioned. Let's say that you're currently 40 years old and you put your retirement age at 65. And let's say that you have $600,000 that you've saved up in your retirement account, and I'm just going to use some before and after returns. Once again, we can argue this every which way. One of the principles in retirement, most people move to very conservative investments in retirement simply because they actually haven't focused on that cash producing net worth, and so they have to play defense. They can't have risk to run out. If you're playing offense and getting that net worth up high enough on cash producing assets, you can actually leave it up and do strategies where you can pull out enough money, for example, for 3 years and put it in some really conservative investments, because most market cycles don't last more than 3 years. If it goes down, you pull out of that. The rest of you can leave invested a lot more aggressive. But if you don't have a big enough base, you can't afford to take that risk. So this is where just help play on offense on your finances. Get ahead of it. But if this example, I can go in and say, okay, well, I need, this one's saying that if that's my time horizon, I don't need to be putting any more in. I can actually stay the path, and that should end up being $4.8 million. I get my 10% off of it, and I'm just fine. Well, what if I look at it and say, well, Brett, I'm tired of working. I want to go to 55. Now I can update that, show that. Well, actually, you're still fine by $106,000, so barely. Now, this is the way most people do it. I'm going to do this scenario. Let's say that they have a $500,000 home, primary residence. Was that a financial freedom liability or asset? Well, it's actually a liability. So if I'm doing this right, even though I have $600,000 in a 401k, if I have a $500,000 primary residence that is not producing net cash for me, my number actually has to change to $100,000. I need to be putting $4,700 a month into my wealth plan to achieve that goal by age 55. And this is where we can change it. It's your plan. What if you tell me, hey, it's 65? Hopefully this is helpful. We can look at it. You need to be putting $970 a month. Once again, it's your plan. I'm going to go back to that example of 55. So now you know that if this is really where you're at for financial freedom, you need to get $4,700 in your wealth plan. So you can force that in out of your income. That's probably going to be 10% more than 10% of your income to make that happen. That becomes discouraging people. But let's consider real estate as an example. Let's say that we used equity in your home. I'm just use that as an example, and we bought 2 properties worth $500,000. So you have $1 million just in a market that's appreciating at 5%. That's $50,000 a year just in appreciation. If I take that $50,000 divided by 12, that is $4,166 a month just in appreciation. That is incredibly powerful for you to be able to get to your retirement goals. Real estate is incredibly powerful because you can pull the cash flow in. I think it's important to have diversification in other assets, but when you put real estate to work for you, rather than you trying to work and get everything into your retirement portfolio, the results are exponentially faster. You'll see that this net worth will grow dramatically, and as that equity grows, it will give you options. I have found over time, this is just a common general principle that I found, is clients get older, even if they built a large real estate portfolio, it's not uncommon that they start selling it and just rolling it into stocks and bonds and investments, just because the stress of what if the roof gets a leak, or what if this tenant needs me. The older tend to get, the little things, smaller things tend to become bigger on us emotionally. But if all of a sudden those properties over 10, 20 years have appreciated and are worth $2 or $3 million more, and you can now sell that and roll it into more financial assets, you have options. And that's the beautiful part. Maybe you keep the properties. The goal is to have options. You can live life on your terms. And real estate is a fantastic tool to be able to run that. So if you're curious about where you're at, address the truths. Run your true net worth statement. It may be negative for many of you. That doesn't mean that we can't start somewhere. Let's define what your goals are and get after them. And real estate is a great, great way to be able to do that. Thank you for sharing your time today. That's been a little bit of a journey as we've gone through that, but I hope that the content, at a minimum, has just created ideas, possibilities. Could it be for you? Well, let's figure that out. I hope that as you're evaluating your vision, you'll feel comfortable reaching out. I want to get to know you, and your situation will be unique, so let's figure out how to execute your vision. As I mentioned, finding the right team is important. I'm connected with several great real estate agents, accountants, financial advisors, property managers, and we can help you find that right team to put together to create your wealth plan. If you are a realtor or a financial advisor or an accountant looking at saying, hey, this would be helpful with my clients, I'd love to partner with you and get to know you, feel free to reach out. And licensed in several states, don't hesitate to connect with me. 801-628-6771 is my cell phone number. You can find me on social media, on LinkedIn, and lots of different social platforms. I just invite you to reach out. This is what I love to do. I hope you can see that. It's why I continue on in the career. Real estate has changed my life. Understanding these principles has changed our family's life and our ability to live on purpose and go after our dreams. And that's what I really invite you to have the courage to reach out and to find that plan. Don't just flounder on your own and say, well, I wonder about this, and be back to investing on your own. We want to be able to be a resource to help you effectively capture your dreams. So reach out today.